All right, good afternoon, everyone, and Happy New Year. My name is Drew Prisky, and I'm a shareholder here at DunlapSLK. Thank you for bearing with us for a couple of minutes as we were getting through some technical difficulties, but we think everything's worked out here and we're gonna move along. So on behalf of the entire DunlapSLK team, I wanna welcome you all to our webinar on the Consolidated Appropriations Act of 2021. If you're like me, I don't think you could have possibly imagined we would still be meeting virtually and doing webinars on government bills and acts 10 months after the pandemic started. But we hope you have been staying safe and well during this time, and hopefully we are approaching the light at the end of the tunnel. So for now, we're happy to be back in front of you, and we're going to be discussing the main provisions of the Consolidated Appropriations Act, which I'll be referring to as the CAA throughout the webinar. A few quick housekeeping notes before we get started. One, normally I would be sharing my screen here with you guys, but part of our technical difficulties was not allowing me to do that. So we have Renee Stoltz with us, who is going to be sharing her screen. And as we move through the webinar here, we're recording this webinar. It'll be posted online within the next couple of days. So if you need to go back and refer to anything, you'll be able to do that. There's a slide deck that you'll be able to access on your own, and you can follow along on screen. The recording and slide deck will also be sent to each of you following the webinar. Please excuse my slight head turns here throughout the webinar. I'm going to be referring to a couple different screens as we go through things. So as mentioned, Renee Stoltz is with us. She'll be sharing the screen, and she'll try to pay attention if you're having any technical difficulties hearing or seeing things. You can post them in the chat. I'd also like to introduce Tracy Kelso, who will be fielding any questions you have throughout the webinar. For both questions and technical difficulty issues, please post them in the chat, and one of them will respond to you. We're planning to run about an hour today, so due to time constraints, Tracy may just answer some of your questions in the chat, and I will pause periodically throughout the webinar, and we'll be taking some questions at the end. To keep things moving, we may only be answering 2 or 3 questions at a time when I pause, but rest assured, if we don't get to your questions, we'll try to answer them at the end if time allows, or we will follow up with you individually after the webinar if we can't get to all of them. So finally, as mentioned in our invite, we're going to touch briefly on PPP forgiveness today. But again, due to some time constraints, we're not going to step through the applications themselves. If you have questions about the inner workings of the application, we encourage you to reach out to your accountant here at DunlapSLK or elsewhere, and they can provide you with some more guidance. With that being said, let's dive in. So the CAA was passed in late December and features many extension or revisions to existing credits and loans that are part of other acts, specifically the CARES Act and the Families First Coronavirus Response Act, which both of those passed at the beginning of 2020 and late in the first quarter. Many of these provisions are aimed at businesses that continue to be hard hit by the ongoing pandemic. So we'll be recapping the original acts as we go along. Because you will see that in most cases, none of the original guidelines have changed. They've just been expanded to offer more to smaller businesses and excluding some of the larger businesses that we'll talk about. So we're going to begin by discussing the extension of the FFCRA. So Renee, if you could move on to the next slide, please. Just give me 1 minute here, sorry. Okay, sorry about that. So the FFCRA, and we're going to be giving you a lot of, as mentioned, a lot of the original recaps of the rules here. So the original law was an employee is eligible for paid sick or family leave under the Act to the extent that the employee is unable to work or telework due to a need for leave. Those reasons are the employee's been advised by a healthcare provider to self-quarantine for reasons related to COVID-19, and the employee is caring for an individual who's subject to an order described above, or if the employee is caring for a son and daughter because their place of daycare or school has been closed. If you happen to recall in the original provisions of the Act, they put out a 6-pointed poster that we still have a link to it on our website if you need to refer to it, but those were like the 6 reasons. I think 3 of them covered family care, 3 of them covered the sick care. So you can still refer to that poster for the reasons people may be claiming. The care for child care, that is the one where you get the extra 10 weeks. So you'll see here in a second that 80 hours is the amount of sick leave or family leave you get. And if you have child care reason, you will get an additional 10 weeks. Most of the daycare schools are back open or doing some sort of virtual. So those reasons are probably going by the wayside. So 80 hours is what you get. If you're part-time, you're going to look at the 2-week period that the employee normally works, and you're going to average the hours there. The sick leave should be paid at the employer's regular rate to seek the diagnosis for family leave, or 2/3 the rate. I'm sorry, that was for sick leave. 2/3 the rate for family leave reasons such as childcare. So Renee, next slide, please. Oh, go back one. So for sick leave, $511 per day is the max you can claim for an aggregate of $5,110. That's per employee. For family leave, it's the 2/3 rate, and that's a maximum of $200 per day. You can choose to pay above these limits, but you're not going to qualify for the credit if you're in excess of these limits. So you would get the credit up to those limits. Anything above, you're going to cover on your own if you choose to do that. The tax credit that's available is the Act's going to provide a refundable payroll tax credit for employers paid on family leave or sick leave due to COVID-19. It's going to be 100% of the qualified wages that you get to take that credit on. And you also get 100% of the qualified wages for the next 10 weeks if that's due to the child care. You can include the cost of maintaining health insurance. If the employee's out of work and you're going to pay their health insurance, you are able to include that as a cost. And you'll be able to deduct current withholding still out of their pay as you're paying them. So the next slide. So that was the original law. None of that's changed. The new parts of it is that it now extends. It was originally set to expire December 31st, 2020, and now it's going to run through March 31st, 2021. The biggest kicker to this is that the employers are no longer required. The original law was a mandate employers had to abide by, and they had to offer that 80 hours. They no longer are required to do that, but they can continue to do so if they choose. And if they do so, as long as it's meeting one of those eligible reasons, they can take that credit and record it on their payroll tax return and get the money back there. Another key thing to note is that unless an employer has a policy that specifically states FMLA, remember this is an expansion of FMLA benefits. So unless an employer has a policy that resets on a calendar year basis, an employee's year under FMLA begins the day they start taking the leave. So if there's not a policy already in place, which I can't imagine many employers have such a policy in place, but I could be wrong, at least small businesses, you're going to not be able to take the 80 hours just because it's a new year. So if they've already gotten 80 hours from March through December, that's unfortunately what they get. If you choose to pay them for additional time off, you're not going to be able to record that as part of the FFCRA credit. So I'm going to pause there. Is there any questions at the moment for stuff on FFCRA?
Drew, we don't have any questions at the moment.
Okay. Thank you, Tracy. Renee, if you could take us to the next slide, please. The employee retention credit. The recap of this might be new to a lot of you because with a lot of, for instance, with a lot of my clients, I knew they were applying for PPP, so I didn't bother going through all the parameters of this credit with them, because the original law is that if you were taking a PPP loan, you would not qualify for this credit. So let's just recap that original law quick, and then we'll, the spoiler alert here is that you now can take that credit even with a PPP. So, but in order to be eligible, you had to be in operation during 2020, and your employer must be, your business must be fully or partly shut down due to a COVID order. So for Pennsylvania friends, think of, Pennsylvania was shut down end of March into April and May. That's the government order. You would qualify for that credit if you were not a life-sustaining business and shut down. If you were still open and weren't shut down, you could also qualify for the credit if your gross receipts were below 50% of any comparable quarter in 2019. And you could continue taking that credit until you reach the threshold of being only down 80%, and you could continue taking it. And not-for-profits were eligible based on this order. They could take this, but it should be noted that the reduction could not be in donations. So if you're a nonprofit that survives mainly on donations, that didn't automatically make you eligible for this credit. And that part, as far as we're aware, has not changed. So Renee, if you can move to the next slide. So as mentioned under the original guidelines, you must not have been utilizing the PPP program. The way the credit is calculated is it was 50% of the first $10,000 in wages paid to an employee from the date this went into enactment, which I believe was March 27th of 2020. And you could take a maximum of $5,000 per employee per year. So the first 10,000 wages, 50% is $5,000. That was your max, and you would run it. Once they hit that limit, you were done for the year. If you were an employer with over 100 employees, full-time employees, you were only eligible to take this credit if your employees were not working. And it couldn't be not working because of FFCRA reasons. It just had to be not working because either you were shut down or fearful. People were fearful of coming into work and you were not paying them. Or I'm sorry, you were paying them. For employers with 100 or fewer, it was all employee wages. So they didn't have to not be working. They could be working. You would still qualify for this credit. And that threshold was based on your average number of employees during 2019. So Renee, next slide, please. So the revisions, the new law to this is anyone who took out a PPP loan or plans to take a second draw of PPP, which we'll get into in a little bit, you can now qualify for the employee retention credit. Given the fact that the wages you claim on that credit, they cannot be used for PPP loan forgiveness. So for instance, you'll see in a minute, the credit now goes to 70%. So on the first 10,000, if you paid somebody 10,000 in wages and took a $7,000 credit, you're only going to be able to use $3,000 of those wages towards your forgiveness. And the fund ordering rule that they put in here is that you're going to, if you're planning to take advantage of this credit, you're going to apply the wages to the ERC first and then to your forgiveness. So you can make an election to not claim the ERC, but that's an election you have to make. So they also clarified that you cannot use the ERC wages to claim any R&D credit. So if you're using wages for R&D, you're not going to get to double dip there. This is effective retroactive to the CARES Act. I'm going to come back to that point in a second. It now extend, again, this was set to expire at the end of December of 2020. It now runs through June 30th of 2021. So some things that apply to 2021 only and forward is that 50% credit is now increased to 70% as mentioned. So instead of 5,000, you can take up to 7,000 if the employee's hitting the 10,000 in wages. The wage limit's not only 10,000, but it's now per calendar quarter. If you'll recall just a minute ago, it's the old act was per year. This is now per calendar quarter. So you could take it in the first quarter and the second quarter of 2021. Instead of a 50% gross receipts reduction, you now only need 20% of a gross receipts reduction. Same thing, you're going to be looking at comparable quarters there. And now that whole larger employee limit about paying employees not to be working, that limit's now 500, not 100. So stepping back to the effective retroactive to the CARES Act here, the biggest obstacle here is there's no guidance issued yet. What it basically means is you can go back and claim this credit for second, third, and fourth quarter of 2020. Now you're going to claim it under the old provisions. Either you were shut down by government order or you're at that 50% test. So that's how you're going to base it off of, but you can go back and claim that credit. There's no formalized guidance yet on how exactly that's going to work. We suspect it'll definitely be involving amending some payroll returns, but they haven't come out and clarified that yet. And the biggest issue that we can see is having that ordering rule about it first being applied to ERC and then to PPP forgiveness. If you were, a lot of people were probably taking their PPP loans right around the time the CARES Act went into place, or as soon as they could, because of fear that money was going to run out. So there are 8 or 24-week periods started, probably into the second quarter, throughout the second quarter, and we suspect second quarter is probably when you might hit this reduced receipts number, or second quarter, like we said, non-life sustaining businesses were shut down. So we could see a lot of employers qualifying for this credit retroactive to 2020 in the second quarter, but you're not going to be able to include those wages as part of PPP forgiveness. So you're going to need to do some manual calculations there if you want to do both. I know we've been, as a firm, in our blasts, if you've been reading them, we've been kind of beating the drum on this about waiting to apply for forgiveness. And it's not because we don't want to help you out. It's just because there continues to be some guidance that always needs to be released on this stuff. So if you're taking advantage of the 24-week, if you got your loan back at back like right around the beginning of the time PPP was available, and you got your loan in April or May there, if you're running an 8-week period, that would have run out June, July, something like that, and you have 10 months to apply for forgiveness. So March into April this year, if you're using the 8-week period, is when you'd start applying for forgiveness. If you're utilizing the full 24 weeks, which most of our businesses will, we think our clients will, because you have a much more longer period to use those funds, you don't need to apply for forgiveness till probably about August of this year. So understanding that a lot of you are anxious to get the forgiveness app going and you're being hounded by the banks to get them in, we would say on this specific issue, if you want to look at the credit, you might want to wait till further guidance is released on how you go about claiming that. So if you are a life-sustaining business and you are open and you don't have any quarters where you were down 50%, so you know you're not going to qualify for this, then you can proceed with the forgiveness applications there. So any questions? I believe that's the employee retention credit. Any questions on that I can answer?
Drew, can you take a step back to the Families First Act?
Yes.
Couple questions for you here. What if you have an employer who has an employee that they don't think is telling the truth about having COVID-related problems? We have offered COVID sick leave to other employees. Can you discriminate against that one, perhaps untruthful employee?
That is a great question. I mean, the employee, so let me step back to the employee, and I apologize, I didn't kind of recap this part of it, but the employee is supposed to give you a statement that they're taking the paid sick leave. And typically, I know we're not trying to pry into individual situations here, but typically a doctor's note or some sort of doctor order to quarantine is probably a really helpful metric for both the employee and the employer to get that credit. And my recommendation there would be you should all be doing that. Like your employees should be giving you reasons. And again, I can refer you back to something on our website where we have like a list of documentation of what the employee is supposed to provide you with, kind of the dates they're planning to take it, doctor's notes and things like that, and keep that on record. If the employee is unwilling to, so first of all, if the employee is unwilling to provide that information or sign that statement, then right away, you would definitely be in your rights to discriminate there because they're not willing to give you truthful information. If they've given you something, that one gets a little dicey, and I might have to refer you to an attorney there if they've given you something, but you still think they're lying. I don't think you can just like flat out discriminate and say, well, we're going to give these 3 employees this and not you because we think you're lying if they have the proper documentation. So I hope that kind of helps weed some of the problem out, is getting that documentation from the employee. And I think you're within your rights as an employer to tell them, we're claiming a credit for this. We need to prove this. We're subject to audit. So, we can't just take your word for it.
Okay. And also on the sick leave, let's say we choose as an employer to extend the sick leave through March 31st.
Mm-hmm.
Are you also required to extend the FMLA paid leave, or can you just choose one or the other?
I don't know that I know the answer to that one. We may have to get back to them on that. I would suspect that you probably want to extend both. I mean, if you want I need you to take this as just my personal recommendation, but the government is going to be covering the credit for you if you can prove it. So if you are in a situation where not having that employee would hurt your business and hurt the production of the business or keep the business going, you are able to deny it based off that. So you can, it can't harm your business. If they're going to be out 12 weeks and you need to replace them, and you're going to have to pay, you're paying somebody else, so you're getting a credit for this one. So it should be a wash there. But we might have to, Tracy, we might have to firm up on that. I don't know if you're going to choose to extend one, you may have to choose to extend both.
Okay, and then finally an ERC question. If we go after the 2020 credit, the original law governs eligibility, meaning gross receipts for a quarter must be down 50%.
Mm-hmm.
The comparable 2019 quarter. The new law of 20% reduction does not kick in.
I'm sorry, I'm having trouble following the question there. Are they asking when does the 20% reduction?
Right, the 20% doesn't kick in until 2021.
Correct, yes, and you're still because 2020 is a down year, you're still able to compare the 2021 quarter to 2019, I believe. So it's not like you're comparing 2021 to 2020. You're comparing it to 2019 when hopefully things were, better for you if you're needing to take advantage of this. Am I answering? Does that seem like it answers that, Tracy?
I believe so, yes. Okay. And then, sorry, I said final, but I want to sneak another one in here for you. For ERC gross receipts, what is the definition of gross receipts? It's not just gross sales, correct?
Yeah, I think it's going to follow. If you're okay with it, I'll pause on that one a second, because I think you'll be able to follow the same definition for some stuff in PPP too. So we can answer that one in a little bit.
Great, that's all for now.
Okay, thank you. So Renee, if you can move on to the next slide, please. Okay, so the tax treatment of PPP loan forgiveness. This should be the one that everybody is most excited about. That's the one that we're most excited about. If you'll recall, the CARES Act indicated that loan proceeds, so we're talking about original PPP here for a second. The CARES Act indicated that loan proceeds that were forgiven would not be included in gross income. So everybody took that to mean not taxable. And that we believe was the intent of the bill. The CARES Act, what it failed to address is whether expenses paid with those proceeds could be deducted on the tax returns, which is obviously the same way of saying they're taxable. You know, if you can't deduct the expenses, well, then the proceeds really became taxable. So when that bill passed, the IRS pretty quickly came out and took the position that these expenses weren't deductible. And I'll just leave it at this, that was based off an existing law that already, when talking about forgiveness of debt. So that's why that kind of came out. And Congress sat on it and everybody panicked all year. And finally, as part of this act, though, they are now saying that expenses paid from the proceeds of PPP loans are deductible. So that is great news for everybody who took one of these loans out. It should be noted that we're still awaiting guidance from the states, though, on this tax treatment of PPP loan forgiveness. There's a chance that they will not follow the federal, and not trying to worry you, but it may be taxable for Pennsylvania and your other states, but we're awaiting guidance on that. And, you know, we'll just mention, you know, like I said, awaiting guidance has kind of become the cliche slogan in the accounting world for the past year and a half or so now. But you know, there's going to be scenarios where your accountant's probably going to advise you that you want to extend the return, and we recommend you take that seriously. I know people don't like extending, but it does not raise red flags with the IRS, and it's more important that you get the return right and maybe wait on some additional guidance than just try to rush to get it done. Now, there may be reasons you have in your own business or lending reasons and stuff like that you can't do that, but you know, and you can have those conversations with your accountant. But just be aware, this is going to be a difficult tax year because there's a lot of changes and stuff going on. So we're certainly not going to get into a long discussion about this here, but partnerships and S corporations, the PPP loan forgiveness shall be treated as tax exempt income and increase your basis. So we're not going to get into a basis discussion right now. That's probably something that's more relevant for your accountants anyway, rather than you personally as a business owner. So, but just be aware that it will increase your basis in the business. So again, all retroactive to the CARES Act. So this isn't like for PPP loans taken out now and going forward, this is the case. It goes all the way back to when the CARES Act started. So that's some great news. EIDL advances, we'll talk about them in a second, but one thing to note here is that they no longer reduce forgiveness. That was previously on the application. You were asked how much your EIDL grant was, and you were supposed to reduce your forgiveness by that amount. You no longer need to do that. If you've already applied for forgiveness and have done that, excuse me, the SBA is aware that that's an issue and they'll be handling that. What that looks like yet, I don't know. I'd recommend if you're in that boat, you probably reach out to your banker before you start paying the loan back and just see where they stand with that, especially if that's your only forgiveness reduction was that EIDL loan. Renee, next slide, please. So EIDL grants, just a refresher of what these were, they're not available anymore, but they were $1,000 per employee up to $10,000. You could potentially qualify for an additional loan on that, but that truly was a loan that you would have to pay back. The thing we wanted to point out here is that they did come out and say that the grant/advance will not be included in taxable income either. And this one, Pennsylvania did issue a ruling on already, so they're keeping that as well, saying that it's not going to be taxable. Hopefully, they take the same position with the PPP stuff. So. And again, just to note that this will also increase your basis in partnerships and S corps, and it's going to be effective, again, as everything has been so far, retroactive to when the CARES Act went into place. So I believe we're going to be moving into PPP next. I'd like to pause there for any questions on EIDL, the forgiveness treatment, or if you still have lingering questions from FFCRA or the ERC.
Drew, we are good for the moment.
Okay. All right. So Paycheck Protection Program. definitely want to give you a recap here because a lot of this stuff is all still relevant for the second draw of the loan. So if you're going to apply for a second draw, keep all this original stuff in mind. So PPP eligible to businesses with 500 employees or less. The allowable uses for the loan are payroll costs, and payroll costs are defined as salaries, wages, and commissions. Any cash or tip equivalent, vacation, personal, or sick time, allowance for dismissal or separation, health benefits, and payment of state or local tax assessed on the compensation. The best way to describe that is your state unemployment tax. If you're in Pennsylvania, that's really the only employer tax that's going to be eligible for this. So, Renee, next slide, please. What payroll costs do not include is compensation in excess of $100,000 as over the cover period. The other types of payroll taxes that you could run into as an employer, specifically your Social Security and Medicare. So the employer Social Security and Medicare and federal unemployment FUTA, those are not eligible payroll costs. Your employees must be living in the U.S. And a key note, just remember this as you're filling out your forgiveness applications, that any payments you received for FFCRA, you can't include those as wages towards the PPP forgiveness. So that wasn't necessarily relevant at the time of application, but is more relevant on the forgiveness end. So continued group health coverage, that not much more to say there except health insurance costs, as mentioned previously. So your other types of costs that you can use, payments of interest on mortgage obligations. So interest being the key, not principal. Rent, utilities, and interest on other debt obligations. So Renee, next slide, please. The borrower must make a good faith certification that the uncertainty exists, basically economic uncertainty exists and is necessary. The loan is necessary to support the ongoing operations of the business. And you need to acknowledge that the funds are going to be used to retain workers and maintain payroll and all these payments that qualify. So we're going to touch on this in more detail in a second here. So the forms that are available, so it's Form 2483 and Form 2483 SD, which SD stands for second draw. I'll mention here, if you were late to the party on applying for the first round of PPP, or maybe situations have changed and you now think it would be helpful to qualify for this, you can still do a first draw under a lot of these parameters, but most of this is going to be geared, most of this discussion here will be geared at the second draw recipients. So instead of 500 employees, you now must have less than 300. So if you were in that range between 300 and 500 and you got the first draw, you're unfortunately not going to qualify for the second draw. You must have another gross receipts test here, and this one is pretty hard and fast. So you must have a gross receipts reduction of 25% when looking at any quarter in 2020 as compared to a quarter in 2019. So similar to what we discussed on the ERC, you're going to be looking at comparable quarters, but this time the threshold is now 25%, not 20%. This right here, the question an individual had earlier, gross receipts, you can probably define it the same way for both PPP and for ERC. Gross receipts are defined as revenue from whatever source in accordance with the company's accounting method, but also to include interest, dividends, rents, royalties, commissions, fees, and then you are supposed to reduce it by your returns and allowances. So your PPP, though, forgiveness does not count. So you're not going to be able to, as mentioned, on your books, that'll show up as income, and then you'll make an adjustment on the tax return to make that not taxable. But you're not going to be able to show that as, forgiveness income and say, oh, I had a reduction in gross receipts because of that. I'll pause here a second and I apologize, this is not on the slide, but I've gotten a lot of questions over the last few days of, well, is it cash or is it accrual? And SBA has released you can search for it, or I can have our team attach it to the slides here. The SBA has released an FAQ talking about the reduction of gross receipts and how you prove it and what method you should do it on. The method you should do it on is whatever method your books and records are normally kept on. And the way I'd describe that is, if you're a business that requires a financial statement for a bank or any other reason, you'll either be on the cash or income tax basis there, and I'm sorry, accrual or income tax basis there. And whatever basis that financial's on, that's going to be the basis you want to base this test on. If you don't have a financial statement, you're probably safe to go with what's on whatever method you record on your tax return. If that's the cash basis, you go on the cash basis. Accrual, go on accrual. If you're a cash basis financial statement, but then you do if you're accrual basis financial statement and you do a cash basis tax return, we'd still default to the financial statement there. So if you're a QuickBooks user, and I'm sure there's other programs that do this, you may be aware that they keep track on both bases, no matter what you actually are. We're recommending you don't play games with it. This is a pretty hard and fast line. And some of the documentation that you're going to be required to provide is quarterly financial statements for the entity. And if those financial statements are not audited by an accounting firm, then you can provide internal ones, but the business owner is going to have to sign each page of that statement. Well, sign the first page and initial each page thereafter. And you're attesting to the fact then that these receipts have really dropped. So, be aware that, there could be severe penalties and stuff like that for playing games with, moving stuff around. They may request your bank statements to see when the deposits actually went in. So just moving stuff around on the books isn't going to help you there. The bank statements don't lie. And some banks are even asking for your IRS tax filings, your tax returns. Couple points there. One, we obviously know in most cases your 2020 return is not filed yet. Two, the tax return does only show things on an annual basis, not a quarterly basis. So a little confused. It's probably more a verification thing for the bank to see that, how much your overall receipts dip. If they are asking for that and you haven't completed your return, you are able to just fill out a dummy copy of the first page of the corporate tax return and put in your gross receipts. You don't have to fill out all your expenses or anything, but put in your gross receipts and sign the bottom, and you're attesting that this is what we're going to report on the tax return. So be aware as you're going through the portals and when you get into the application process, the banks may ask for certain things, and you want to be in communication with your banker about what they really need. So I think the best metric is those internal financials that you're going to attest to and sign off on. So on the second draw, you're gonna indicate that you have used or will use all of your first draw before the second loan is dispersed. So because of the time frame of when this is coming out now, most people, again, if you got loans back in March and April, you're through your 24 weeks. So you have most likely used all your PPP in the first round. But if you were in that, once they refunded it and restarted the program for a little over the summer and you haven't used all your money yet, you're going to need to wait until you do to apply for a second draw. So another thing I'd like to harp on here a bit is you still need to satisfy the necessity test that the loan's necessary to support ongoing operations. That became a pretty easy obstacle to clear in the first round of funding because as we've discussed, all non-life sustaining businesses were under a shutdown order. The pandemic was new to everybody. We didn't know how long it was going to be. There are a variety of reasons you could have put down that an economic uncertainty exists, and then the SBA made your life even easier if the loan was under $2 million by just saying you were considered to have met that threshold. So right now, no threshold exists on that, or the SBA, at least yet, as of today. and we're not in a shutdown at the current moment. So it doesn't mean you can't go apply for one of these loans if you qualified, but we just want to make you aware that you need to be certifying you have an economic uncertainty. You could throw a variety of reasons still in there because, you know, the vaccine's not out yet. I imagine many of business owners still have people coming and going on FFCRA. You know, who knows? You know, we thought, like we said, I think a lot of us thought this would not be lasting as long as it had. So there's probably a variety of reasons you could still put down. We're recommending that you document that. You won't need it for the application itself necessarily, but you don't want to necessarily be trying 10 months from now when you're going to apply for a second round of forgiveness and they say, hey, what, you know, why'd you need the loan? Because that may happen. These bills have come out, these acts have come out, and with the guidelines, and then they change them. You know, so I truly mean this as not to scare you. I'd encourage you, if you have a reduction in gross receipts and you can use the money, to consider applying. But if if you are a business that maybe took a hit in the second quarter, but you rebounded pretty strong in the third and fourth quarter, and there's no end, no end in sight that it's going to slow down, that first of all, that's obviously great for your business, but that's a situation where you just want to be a little more cognizant. So just wanted to mention those couple things. So the eligible borrower, the loan is calculated based on the following, and you as the borrower can make this selection. You can either use the 2019 data that you already did in your first round, or if you had a change in employee status, number of employees went up or down, you want to look at both of those. It may be more beneficial to use the 2020 payroll data or the year, basically the year preceding the loan. And you also want to be, the reason you want to consider that, even though you might get less, if you have less employees now, you might get less of a loan. But remember, you got to use all this on payroll, and you got to, cover people. So maybe your length of time will be enough. But just keep in mind that if you had a substantial change in employees, you might want to look at the 2020 data. But in most cases, I think our employers will be utilizing the 2019 data. You're still going to multiply it by 2.5 times. So you're going to take your total payroll for 2019 and all your payroll costs that were defined back at the beginning. You're going to divide that by 12 and multiply that by 2.5 times, and that's the maximum amount you're allowed to receive, unless it's more than 2 million, in which you're going to get capped at 2 million. And remember, you need to back out your people that you need to annualize them down to 100,000. You don't need to back them out of the calculation, but you need to cap them at 100,000. Like I said, simplest way I suspect would just be to go, if you haven't had any substantial changes, is to just use your 2019 data, because the bank's already got that. So it might make your application process a whole lot simpler. If you are an NAICS code of 72, which is your hotels and restaurants, you're going to get 3.5 times your payroll, as those have been some of the hardest hit businesses. So, Renee, next slide, please. One other note about the certification of revenue. If your loan is 150,000 or less, when you submit your application, you can simply attest that you have a revenue loss, and you don't need to prove it until you go to apply for forgiveness. That's what the bill and act says. I'll tell you right now, we are hearing a lot of banks are tossing that one right out the window and say, nah, you're going to show us that proof up front, because they don't want issues on the back end. So I would be shocked if there are many banks out there letting you do that. I don't recommend it anyway, because again, it's going to be something that when you go to forgiveness, you're going to have to go back, 10 months plus maybe your 24 weeks to try to figure that out. So the forgiveness rules themselves, as far as, how it's all going to work and stuff, and what qualifies, none of those have really changed. And so all your payroll costs, all the stuff mentioned back at the beginning of what's eligible forgiveness, for forgiveness, that stays the same. And keep in mind that 60% must be spent on payroll costs. Renee, next slide. A couple other additions here. As far as payroll costs go, instead of just health insurance, you can now include life, disability, vision, and dental insurance as eligible payroll costs. And again, that's going to be retroactive to when the CARES Act. So obviously, when if you're applying for forgiveness on your first round of PPP, you can now include some of these expenses as payroll costs to help you meet that 60% threshold. Some other costs it includes are, sorry, one second here, are covered operation expenditures. And the simplest way I can describe that is software and cloud expenses for maintaining your business. And I believe that's kind of related to the working from home thing. So pretty much any software or cloud computing service that you're using that is necessary to the business operations, there's a whole list of, tracking and payroll and human resources and all that. But pretty much if the business is relevant to your software, it's the monthly expense for it or whatever is eligible cost. If you have suffered property damage, and it's specifically property damage caused by vandalism or looting during the public disturbances. So hopefully that wasn't an issue for too many businesses. Covered supplier costs. This one's there's a lot that goes into this one that I don't have time to cover all here. But it would seem to mean that it's an expenditure made by an entity to a supplier of goods. Are those goods your cost of goods? Potentially. I think my recommendation would be if you need to look at some of these costs, you talk with your accountant about that, and more details can be provided there because it's a long list of very complicated language that we're not going to go into right now. Worker protection expenditures, that's, common term you hear is PPE. So some stuff there that qualifies is the purchase, maintenance, and renovation of any assets that create or expand the business. Probably specifically stuff if you've expanded to help social distancing and stuff like that, they would qualify. A drive-through window facility, some indoor or outdoor pressurized air systems, and physical barriers that you've put up, all things like that. And there's probably even more stuff that goes into that would qualify. Again, these are all retroactive. So if you were having trouble meeting the full forgiveness on your first loan, you can include them. However, if your loans were already submitted for forgiveness, so it does seem like you're out of luck on these additional costs. So if you had a reduction and this could have helped you for whatever reason, but you've already submitted your forgiveness application, you unfortunately might be out of luck there. The covered period for forgiveness, pretty simple. So first round, it was either 8 weeks or 24 weeks. Now it's any time between 8 weeks and 24 weeks. You can choose as the borrower, and you're probably going to make that election when you go to apply for forgiveness. So just keep in mind, we haven't heard anything different about the 10 months. So if you're choosing to only go 12 weeks, then you got 10 months after that 12-week period ends. If you're going 14 weeks, 10 months after that 14-week period ends. So again, if you're not changing your employee, your amount of employees, and you're going to continue paying people, probably makes sense just to use the 24 weeks. So a couple last things to get into, but let's stop for a second. And any PPP2 questions?
Good question here, Drew. Is it possible on the PPP loan application to apply for less than 2.5 months of payroll?
I think you can. If they're going to go with whatever records you submit with it. So I don't think you have to take the maximum amount of loan if for some reason you don't think you're going to use it all. I would, if you're going to go that route, I would definitely be in contact with your banker though, because I don't know if I mentioned this or not, but a lot of these applications are all being done on a portal, and you're just going to upload some documents and it's going to go off to a team to process. So if you're not going to go with the basic metrics of it, I definitely make sure your banker is aware of that. But I think you can.
Okay, thanks, Drew.
Okay, so the little bit we wanted to touch on PPP forgiveness. And what we're mainly going to do here is a refresher of the applications that are available. As mentioned, we're not going to step through a specific application because there's a lot of nuances that go into it, and it would just it takes a while. They're not all necessarily insanely difficult, but they can be tedious. So the 3508EZ, that is an application that's available to borrowers who were sole proprietors with no employees. Though if you're in that class, you're probably just going to want to fill out the 3508S that we'll talk about in a second. So this one's probably more focused to any borrowers who are going to be over the 150 limit and did not reduce any employees or wages. So there does not appear to be a dollar limit on this calculation. You're still going to have to submit backup and stuff and proof, but if you didn't reduce anybody, it sounds like you can use this simplified application. The 3508 itself, that is the full-blown 6-page application, and that's where you're going to have your various schedules showing all your computations and stuff. That's going to calculate if you reduced FTEs or salaries. So that one, there's a lot of number crunching that goes into that one. Again, more tedious than difficult, but you know that you'll have to do that, and that'll determine the amount of forgiveness that you get there. So, and the way the applications are reading is like you could potentially have a reduction of forgiveness, but that reduction is tapped off your total payroll costs in the 24-week period. So a quick example I would like to give you as the way the application seems is if you had a PPP loan that's $500,000 and your total payroll costs during the 24-week period that you took is $800,000, and you did have to let some people go or for whatever reason, you have a reduction. If that reduction would calculate to be like 100,000, you still spent 700,000 on payroll costs. So during the eligible period, so you could potentially have a reduction and still receive full forgiveness there, but you still need to go through the calculations and do it. The way the front page of that application reads is it's going to take the lesser of your loan amount, your adjusted payroll costs, and then they still make sure you used it 60% there. So, some good news there. That's the way the application seems to be reading. I'd verify that's how your banks are going to be looking at it, but that is definitely how the application reads. So both of those applications, they do require the borrower to submit proof. So that's where you're going to be submitting your payroll records. If you're using any sort of calculator or tool, you might want to submit that along with it to show how you came up with your numbers. The 3508S, that's a simplified application that had already previously come out, and it was just targeted at 50,000 or less. So now they've upped that limit to 150,000, and they've just revised and released that application yesterday. They've taken out some certifications and made it even simpler than it was before. So it replaces the old 3508S, and it now only has 2 certifications, and those certifications are going to be that the borrower has complied with all requirements of the PPP, including any interim and final rules, that they use the proceeds for what they were supposed to. So basically just attesting to the fact that you've used it in the appropriate manner and what you said you were going to use it for. And then the second thing you're initially attesting is that, everything on the application that you're submitting is true and correct. So no documentation required to be submitted. So if your loan's 150,000 or less, your job just got a lot easier on applying for forgiveness. The 50,000 or less, it does seem, so just speaking to those with 50,000 or less for a second, that doesn't seem to matter if you reduced your full-time equivalents or your salaries. You can still they're kind of just giving you a blanket coverage there that as long as you used it on payroll costs and use the whole amount, you're good. If you're between 50 and 150, you can still use this application, but you still do need to see if you reduced FTEs or salaries. So you still need to run through that exercise. And if you did have a scenario where you know, your loan was 80,000, but you're calculating your forgiveness as 70,000, you can simply put that on the one-page certification. They don't ask to see anything about that. So you can still submit that easy application, but you're still going to have to step through and see if you reduced anybody's wages or employee counts. Renee, next slide, please. So as mentioned, the loan shall be forgiven if the borrower signs and submits a one-page lender certification that we just talked about. You should still maintain your records and any calculations you did for 4 years. So like you said, you don't have to submit them with it, but you want to retain them for your records in case it's ever looked at. As mentioned, this revised application just came out yesterday, so I'm not sure where the banks stand with it, but I suspect they're working on updating their portals, but it might, you know, you might still have to wait a few days yet till that's up and running. So, and again, as always, retroactive to the CARES Act. So, you know, it's not for loans given today or later, you know, since this bill's passage or later, it goes all the way back to the original PPP. So your first draws and stuff can all use this. I'll just rip through these quick and then we'll take some final questions. This is the last thing we wanted to cover here. Just some other noteworthy employer tax items to be aware of. If you're an employer that offers an FSA, your employees are now allowed to roll over their funds. Typically an FSA, when employees put money into it, it's a use it or lose it in that year situation. They can now roll it over, but a key thing is you do need to amend your plan document. It sounds like it's a very simple amendment, and your third-party administrators on it should already be aware of this amendment, but you do need to contact them and put something in writing that they're allowed to do that. This is going to be in place for 2 years, 2021 and 2022, this rollover. And these funds, so any funds from 2020 that roll over into 2021, they all have to be used by the end of 2021. And any funds you put in by 2021, they all have to be used by the end of 2022. So, so if you're in that situation, highly recommend you get in touch and get that amendment in. Business meal deduction, typically, so remember they got rid of meals and entertainment. It was just down to meals, business meals, and you got 50%. They are taking that up to 100% deduction. But a fun key is that this is aimed more at helping the restaurants, not helping you. The restaurant, it must be provided by a restaurant. It can be takeout, but it must be provided by a restaurant. Not going to Wawa, not going to your local grocery store and getting some stuff. So, and the last thing, work opportunity tax credit. If this is something you're interested in hearing more about, definitely reach out to your accountant about it. But this credit was originally set to expire. It was either 2020 or 2021. I apologize, I can't remember, but it's now extended through 2025, so that doesn't matter anymore. And this credit is for hiring disadvantaged workers. Typically, it's anybody who's a former convicted felon, a food stamp recipient. There's a few other metrics that meet it, and it gives you a credit based on the amount of wages you pay them. There's a decent amount of paperwork involved with this, so not to discourage you from doing it, but you're probably going to need some help with it, and you probably want a few employees that may meet this metric before it's really worth your time and effort. So the hour went quickly, I feel, but that is everything we wanted to cover. So we are at 2 o'clock, but we can hold on for just a few minutes and take a few questions, and we'll probably wrap up in 5 minutes or so. And if there's anything we don't get to, we will reach back out to you.
Drew, at this point in time, we don't have any open questions. We have a couple people to follow up with after the webinar, but you did a great job explaining everything, so we have no further questions.
Okay. Yeah, we either did a good job of explaining, or threw too much information that you're overwhelmed now. But anyway, thank you for the questions you had throughout the webinar, and we'll follow up, as Tracy mentioned, with anybody who we have to get back to. So I wanted to thank all the members of the COVID team at DunlapSLK who helped put this together, and a special thanks to Renee for running the slides and working through any technical difficulties, and Tracy for assisting and fielding questions. So On behalf of the entire Dunlap SLK team, I want to thank you for attending today's webinar, and we wish you a safe and prosperous 2021.